Hello everyone. Welcome back to AccountantsMinds. I hope you enjoyed our previous lessons on the double entry system and the accounting equation. In today's lesson, we are going to learn types of accounts, which is another very important topic in accounting. Before we record any transaction, we must first identify the type of account involved. If we identify the account correctly, recording journal entries becomes much easier. So, let's begin. First, let's see what we are going to learn in today's lesson. By the end of this lesson, you will be able to understand what types of accounts are, identify the 5 main account types, classify different business accounts correctly, and understand why this topic is important in accounting. Don't worry if these terms are new to you. We'll learn them one by one using simple examples. Let's start with the basic question: what are types of accounts? Every business has many different accounts. For example, cash, furniture, bank loan, capital, sales revenue, and salary expense. Instead of remembering each account separately, accountants classify them into groups. These groups are called types of accounts. In financial accounting, every account belongs to one of 5 categories: assets, liabilities, owner's equity, revenue, and expenses. Once you know these 5 types, accounting becomes much easier. Now let's understand why learning these account types is so important. You might wonder, why do I need to know the types of accounts? The answer is simple. Every transaction starts by identifying the accounts involved. If we don't know whether an account is an asset, liability, equity, revenue, or expense, we may record the transaction incorrectly. Understanding account types helps us record journal entries correctly, apply debit and credit rules correctly, prepare accurate financial statements, reduce accounting errors. So, identifying the account type is always the first step in accounting. Let's begin with the first and one of the most common account types: assets. An asset is a resource owned or controlled by the business that has value and provides future economic benefits. In simple words, an asset is something the business owns and uses to earn income. For example, cash helps the business pay expenses. Inventory is sold to customers. Equipment is used to produce goods or provide services. Furniture is used in the office. Buildings and vehicles help the business carry out its daily operations. These are all assets because they are owned by the business and help it operate and generate future benefits. Now that we know what assets are, let's see how assets are classified. Assets are divided into 2 categories: current assets and non-current assets. Current assets are expected to be used, sold, or converted into cash within 1 year. Examples include cash, inventory, and accounts receivable. Non-current assets are assets that are used for more than 1 year. Examples include land, buildings, furniture, equipment, and motor vehicles. This classification helps businesses organize their financial information more effectively. Let's look at a practical example to understand assets better. Let's take the example of ABC Traders. The business owns cash worth 100,000 rupees, furniture worth 80,000 rupees, a vehicle worth 500,000 rupees, and inventory worth 200,000 rupees. All of these are assets because they are owned by the business and provide value. Notice that some assets, like cash and inventory, are current assets, while furniture and vehicles are non-current assets. This shows that a business can own different types of assets at the same time. Now let's move to the second type of account: liabilities. Liabilities are obligations or debts that the business must pay in the future. In simple English, liabilities are money that the business owes to others. For example, if a business borrows money from a bank, it has to repay that loan in the future. Therefore, the bank loan is a liability. Other examples include accounts payable, salary payable, rent payable, and tax payable. A simple way to remember this is: assets are what the business owns, while liabilities are what the business owes. Just like assets, liabilities are also divided into 2 categories. Liabilities are classified as current liabilities and non-current liabilities. Current liabilities are expected to be paid within 1 year. Examples include accounts payable, salary payable, and rent payable. Non-current liabilities are obligations that will be settled after more than 1 year. A common example is a long-term bank loan. This classification helps businesses know which debts must be paid soon and which can be paid later. Now let's look at the third type of account: owner's equity. Owner's equity represents the owner's claim or investment in the business. Imagine you start a business by investing 200,000 rupees from your personal savings. That investment becomes the owner's equity. We can also calculate owner's equity using this formula. Owner's equity equals assets minus liabilities. This means that after paying all the business's debts, the remaining value belongs to the owner. Examples of owner's equity include capital, additional investment, and retained earnings. Next, let's learn about revenue. Revenue is the income earned from the normal activities of a business. In other words, revenue is generated when the business sells goods or provides services. Examples include sales revenue, service revenue, commission income, interest income, and rent income. Remember, revenue increases the business's income. It is different from cash because revenue is earned from business activities, while cash is simply an asset that the business owns. To earn revenue, every business has to spend money. These costs are called expenses. Expenses are the costs incurred to earn revenue and operate the business. Every business has daily operating costs. Examples include salary expense, rent expense, electricity expense, telephone expense, advertising expense, and insurance expense. Without these expenses, a business cannot operate effectively. So, expenses help the business generate revenue, even though they reduce profit. Now let's compare all 5 account types together. Let's quickly compare the 5 account types. Assets are resources owned by the business. Liabilities are obligations owed to others. Owner's equity is the owner's investment or claim in the business. Revenue is the income earned from business activities. Expenses are the costs incurred to operate the business. This table gives you a quick overview and is useful for revision before exams. Before we finish, let's look at some common mistakes that beginners often make. Many beginners classify accounts incorrectly because they focus only on the account name instead of understanding its nature. For example, cash is not revenue, it is an asset. A bank loan is not revenue, it is a liability because it must be repaid. Capital is not income, it represents the owner's investment. Furniture is not an expense, it is an asset because it will be used for many years. The best way to avoid mistakes is to first ask yourself, what is the purpose of this account in the business? Once you answer that question, identifying the correct account type becomes much easier. Let's finish today's lesson with a quick summary. Today, we learned the 5 main types of accounts: assets, liabilities, owner's equity, revenue, and expenses. We also learned their definitions, characteristics, classifications, and practical examples. Most importantly, remember that every account belongs to one of these 5 categories. If you can identify the account type correctly, you'll find it much easier to learn debit and credit rules and prepare journal entries. Thank you for watching this lesson on Accountants Minds. If you found this video helpful, please like, share, and subscribe to support the channel.